let's move on and take a look at some more news and updates. The European Central Bank keeps interest rates unchanged in line with street expectations. According to commentary from the central bank, the September meeting was wide open as it downgraded its view of the Eurozone's economic prospects and predicted that inflation would keep on falling. Remember, the central bank cut rates from record highs last month in a move that even some of its policymakers considered rushed given stalling disinflation, and a few hints, of course, to support bets on another reduction in September. However, President Christine Lagarde is of the view that risks to growth were tilted to the downside, and that's a shift from her previous formulation that they were balanced over the near term. Let's go across and listen in to that slice of what she had to say then.
So the question of September and what we do in September is wide open and will be determined on the basis of all the data that we will be receiving. Obviously, our projection from June will be a point of reference, but the projection of September plus all the other elements that we will be receiving will be taken into account to decide what we do in September. But there is no predetermined path, and that was very strongly endorsed by the Governing Council. The Governing Council today decided to keep the three key ECB interest rates unchanged. The incoming information broadly supports our previous assessment of the medium-term inflation outlook. While some measures of underlying inflation ticked up in May owing to one-off factors, most measures were either stable or edged down in June. In line with expectations, the inflationary impact of high wage growth has been buffered by profits. Monetary policy is keeping financing conditions restrictive. At the same time, domestic price pressures are still high, services inflation is elevated, and headline inflation is likely to remain above our target well into next year.
All right, let's step away from the European Central Bank holdings rates steady as the street was expecting. But meanwhile, the International Monetary Fund, or the IMF, in its latest commentary indicates that the Federal Reserve should not cut rates until late 2024. Additionally, it also believes that the government needs to raise taxes that slow the growing federal debt, including on households' earnings less than President Joe Biden's $400,000 a year threshold. Of late, the fund has been emphasizing the need for more fiscal prudence as US deficits continue to grow despite robust economic growth.
All right, keeping it with central bank commentary, Federal Reserve Chicago President Austin Goolsbee in his latest messaging indicated that the central bank's fight against inflation is not over but is on track. Pointing to declines in housing and services, Goolsbee said that this is about as fast as inflation has ever fallen in the US without slipping into a recession, referring to the journey as the golden path. With respect to the labor market, then, Goolsbee notes that it has been cooling, saying it's definitely an area of concern, one to keep your eye on. Meanwhile, San Francisco Fed President Mary Daly also sounded optimistic on inflation, even as she said the prices are far from stable. So that's important commentary that you should keep an eye on.
All right, let's talk about some earnings then from two major American companies coming in. You have Netflix as well as TSMC. Now, global streaming giant Netflix delivered strong quality results with robust subscriber addition figures and strong growth in its advertising business. The streamer said its ad-supported memberships grew 34% during the period compared to the same quarter last year. They've also seen that they see plenty of room to grow in India, so that's some positive commentary coming in. Meanwhile, you have TSMC that has ridden the AI demand, raising its full-year revenue guidance given surging demand for chips, and rejected the idea of a joint venture factory in the United States.
If you like this video, then like, share and subscribe to ET Now.